In order to effectively master and manage money, it's easy to believe that we have to keep track of hundreds of financial metrics. The day-to-day fluctuations in the market, the ever-changing federal interest rates, oil prices, the inflation rate, job report, PE ratios, dividend yields, and who knows what the talking heads are screaming about on TV today. And if we were to list them all out, this video will be an hour long. But the truth is that just like how the 80-20 rule tells us that 80% of results come from 20% of the effort, in personal finance and investing, the majority of our wealth building success comes from just 3 numbers. Not 300, not 30, just 3. So don't believe the financial industry's lie that you need to stay on top of all these useless metrics. If you get in the habit of tracking and managing just these 3 simple financial numbers, you'll build more wealth than your neighbor with 5 financial advisors and a Bloomberg terminal. Alright, with that, let's get right into it. The number 1 financial number that actually matters. This is the most fundamental of them all, but probably the most overlooked. The savings rate. Yes, the super duper boring savings rate. Of the money that you make every single month, how much do you get to keep? And for those of you thinking, Tay, I already know this. Savings rate? That is so boring and so basic. Well, just stick with me for a bit because I want to share with you a framework that will hammer the importance of this number even more. I want you to look at how much you save, not simply as money you don't spend, but rather as what you're actually buying with that gap. Morgan Housel, the author of The Psychology of Money, said it best in one of his Twitter posts. Don't view it as saving money. View it as buying independence. So when you're choosing to increase your savings rate, you're not just choosing not to spend that money. No, you're actually spending it. But you're spending it on one of the most important things in life. Your independence, your freedom. Money's greatest intrinsic value, and this cannot be overstated, is the ability to give you control over your time. And when we look at it from this framework, you'll realize that income doesn't really matter as much. Let me give you an example. Let's say we have 2 people. Dr. Sarah, an orthopedic surgeon making $400,000 a year, and she saves 10%. Then there's Mike, a high school math teacher making $60,000 a year who saves 40%. The key question is this: who is wealthier? Who has more freedom? At 10% savings rate, Dr. Sarah saves $40,000 a year. Impressive number, right? But here's the problem. She needs $360,000 a year just to maintain her lifestyle. The country club membership, the Tesla payment, the private school tuition, the massive mortgage in that house in the best neighborhood. At a 10% savings rate, it would take her 9 years of saving just to cover 1 year of her expenses. She's trapped in a golden cage with a stethoscope. Mike saves $24,000 a year. Less than the surgeon in dollars, but here's where it gets really interesting. He only needs $36,000 a year to live comfortably. At a 40% savings rate, he can cover an entire year of expenses with just 1.5 years of savings. Fast forward 10 years, Mike has $240,000 saved, enough to cover almost 7 years of living expenses. He could take a sabbatical. He could start that tutoring business. He could essentially do whatever he wants for 7 years without having to worry about a roof over his head and food on the table. Dr. Sarah? After 10 years, she's got $400,000. Sounds like a lot until you realize that's only 13 months of her expenses. 1 malpractice lawsuit, 1 injury that prevents her from operating, and she's in a financial crisis. All those years of medical school, all that stress, all those overnight calls, and she's more financially fragile than a public school teacher. And I see this pattern everywhere. High earners making $500,000 who are 1 bad month away from missing their mortgage payment. An individual with more modest income who could walk away from their job tomorrow and be fine for years. All because of their savings rate. Morgan Housel nailed it when he said independence at any income level is driven by your savings rate. Not your salary, not your investment returns, not some hot stock tip. Your boring, unsexy, life-changing savings rate. So now that you understand the power of savings rate, if you haven't given this much thought, let me share with you some practical next steps. Step 1, this is obvious. Calculate your current savings rate. Understand that if you do not know your savings rate, you're essentially driving life blind. And your savings rate is simple. Don't overcomplicate it. Just take whatever you save each month, including your 401k contributions, and divide by your gross income. If you put away $5,000 each month and your income is $100,000, your savings rate is 5%. Second, step 2. Aim to increase your savings rate. And here's where most people approach this step wrong. Many people assume that the only way to increase their savings rate is to make more money. While that is true, they're missing the low-hanging fruit that is right in front of their face. Cutting your lifestyle cost. Not only is it more within your control, it's a double win. When you cut $1,000 from your monthly spending, you save an extra $1,000 and you need $1,000 less to live on. That single cut just moves your financial independence date years closer. The beauty of high savings rate is twofold. You learn to live on less even as you have more to invest. Alright, before we go on to the next financial number that actually matters, I want to take a minute to address the elephant in the room. Some of you might be watching or listening to this video and you might be thinking, okay Tay, I get it. Savings rate equals freedom. But what is my first step? How should I tackle the beast? Because we all know from personal experience, knowing and doing are two completely different things. And I 100% agree with you. Because here's the truth. 90% of people who watch this video will probably do nothing with this information. They'll nod along, maybe even calculate their savings rate once, then go right back to their old patterns. Not because they're lazy, not because they don't care, but because information without implementation is worthless. And that gap between knowing what to do and actually doing it is exactly why the Financial Tortoise community exists. It's not another course, it's not more information to consume. It's an implementation system designed for busy professionals who are tired of the paralysis that comes from consuming endless financial content without ever pulling the trigger. Inside, we don't just talk theory, we help you build your actual plan. We help you automate through proven systems. We help you simplify and streamline your finances so you can use money to live your life, not the other way around. Through one-on-one coaching, live Q&A sessions, and a private community of people actually doing this work, not just talking about it. And we have the tools to help you execute. Monarch Money for tracking, our Financial Tortoise AI assistant for instant answers, and many more. But more importantly, this is my favorite part. You get accountability. Someone checking in, someone who notices when you've gone dark for 2 weeks, someone who cares. Because here's what I've learned after doing this for many years. The difference between people who truly build wealth and people who just dream about it is not intelligence. It's not income. It's having a system and support structure that turns knowledge into action. So consider joining the Financial Tortoise community if you're serious about taking greater control of your finances and your investments. However, to ensure that every member receives the personalized support they deserve, we only open enrollment a few times a year. So if you want to be the first to know when doors open again, join the waitlist at financialtortoise.com/community. I'll have the link in the description below. Hundreds of members have completely transformed their financial lives by taking greater control over their finances, and with a clear plan and the appropriate support, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's move on to the second number that separates the financially free from the perpetually stressed. The number 2 financial number that actually matters. Let's take it up a notch. The net worth. This essentially is your financial scorecard. Here's an effective way to look at your net worth. Did you know that Amazon, one of the wealthiest companies in the world today, actually lost money for nearly a decade straight? From 1994 to 2001, Jeff Bezos burned through billions in losses. Wall Street analysts called him crazy, and the media was predicting Amazon's eventual bankruptcy. However, none of that happened. Why? Because Bezos understood something they didn't. Income is short-term. However, net worth, in his case balance sheet, is long-term. While everyone obsessed over quarterly earnings, he was quietly building assets. Warehouses, technology infrastructure, customer relationships, patents, data. Today, Amazon's market cap exceeds $1.5 trillion. Not because of their profit margins, but because of the empire of assets they've accumulated. And I feel this is a really good framework to look at our personal finance and net worth from as well. Your salary, that's just revenue. Your expenses, operating costs. But your net worth, the total value of everything you own minus everything you owe, that's your personal balance sheet. That's your personal market cap. That's the number that actually determines whether you're building a wealth empire that can withstand time or just continuously running on a hamster wheel. Robert Kiyosaki nailed this concept in his book, Rich Dad, Poor Dad. The rich focus on their asset columns while everyone else focuses on their income statements. Thus, instead of focusing on income, the number that everyone obsesses over, the number that we should be focusing on is assets. Or more specifically, our net worth. Assets minus liabilities. And here's what you'll discover as you regularly start tracking your net worth number. It will naturally change your money behavior. You'll never look at debt the same way because you'll realize that every liability you take on is something that reduces your net worth. And you'll learn to love assets because you'll see that for every asset you purchase, it helps to appreciate your net worth. Thus, you'll naturally start to act in ways that increases your net worth, not decrease it. And this is how all successful companies look at their company balance sheets. Most companies track something called return on assets, ROA. Basically, how efficiently are their assets generating wealth. The last thing they want is to have assets, such as factories, sitting there not producing income generating activities. Similarly, when you look at your net worth long enough, you'll start thinking the same way. What is this chunk of cash sitting in my checking account doing? Earning 0.01%? Are there better ways to deploy this money? What is this car loan still doing on my books? It's holding my net worth back. Time to pay it off as soon as possible. So if you don't know your net worth, that is your next homework. Calculate it. 1. Simply list out all your assets. This includes your home equity, investment account, retirement accounts, cash savings, valuable possessions. Essentially everything you own that has monetary value. Then 2. Subtract your liabilities. Mortgage, student loans, car loans, credit card debt, any money that you owe. Then 3. Once you have your net worth, work to track it on a regular basis. If you use an account aggregator, it will do that for you automatically. Again, when you track your net worth on a regular basis, I can almost guarantee you that your money behavior will change for the better. That which is measured improves. That which is measured and reported improves exponentially. Alright, let's talk about the third number. And this one, many people don't realize, but is one of the biggest silent killers that is probably stealing hundreds of thousands of dollars from you right now, and you might have no idea. The number 3 financial number that actually matters. Getting into our investment portfolio. Investment fees. Let me tell you about the greatest heist in American history. It's not a bank robbery, it's not a Ponzi scheme. It's happening right now in broad daylight in millions of investment accounts across the country. It's the 1% fee. 1% you might be thinking, that's nothing. That's a rounding error. But my friend, let me show you why that harmless 1% could be the difference between retiring at 55 and working until you're 70. Let me show you the math. Let's say you invest $10,000 a year for 30 years. At 7% returns with no fees, you'll end up with close to $950,000. With a 1% fee, so your net return drops to 6%, you end up with $790,000. That tiny 1% fee just costs you over $150,000 over 30 years. If that is not straight out thievery, I don't know what is. Jack Bogle, the founder of Vanguard and the advocate of low-cost investing, put it this way. In investing, you get what you don't pay for. And I want you to read that again. You get what you don't pay for. Think of it like this. Often when you pay for a car, you get a better car. When you pay more for a hotel room, you likely get a better stay experience. But in investing, paying more gets you less money. It's crazy if you think about it, right? You pay a premium, but you get inferior results. Because here's what Wall Street doesn't want you to know. 92% of actively managed funds, the ones with that high fees, failed to beat the market over 15 years. These fund managers with their fancy MBAs and Bloomberg terminals cannot beat a simple index fund that costs 0.03%. And even Warren Buffett proved this definitely. In 2007, he made $1 million bet with hedge fund managers. His weapon? A boring S&P 500 index fund. Their weapon? 5 hand-picked hedge funds with the smartest managers on Wall Street. The results? Buffett's index fund returned 126%, the hedge funds 36%. But the unfortunate fact is that most people have no idea what they're paying when it comes to investment fees. And in a way, it is designed that way. The financial industry loves to hide their fees in expense ratios, administrative fees, load fees, and transaction costs. And even when you try to find out how much you're paying, fee disclosures are often buried in fine prints or split into multiple documents, making them difficult to identify and fully understand. I once reviewed a community member's retirement account, a really hardworking professional who diligently saved 15% of her salary into a retirement account for many years. But when we tried to understand how much she was paying in fees, not only was it extremely hard to find, when we did find it, we saw her account was full of funds that on average was charging anywhere between 0.8 to 1.2% in fees. Translation? She was unknowingly handing over $8,000 to $12,000 every single year on a $1 million portfolio. And why did this happen? It's because financial advisors are not incentivized to make you rich. They're incentivized to make themselves rich with your money. Charlie Munger said it well. Show me the incentive and I'll show you the outcome. So if you don't currently know what you're paying in investment fees, here is your action plan. Step 1. Find out what you're actually paying. Log into every one of your investment accounts and look for expense ratio or annual fee. If it's above 0.5%, I say you might be paying a little too much. Step 2. Work to lower your investment cost. And the easiest way to do this, especially with your existing investment accounts, is this. Find a broad market, low-cost index fund within your choice of options. Often, they'll have titles like Total Stock Market or S&P 500 within them, and their expense ratio shouldn't be more than 0.04%, most often lower. And understand, these are not sexy investments. They are as vanilla as you can get, but over the long run, they will make you rich. Now, some of you savvy investors watching this video might raise an eyebrow because while I talked extensively about investment fees, I haven't talked about other investment metrics that are also important. Asset allocation, diversification, turnover ratios. And I admit, those are important metrics, and those are the next numbers I recommend you look at after controlling for your investment expenses. However, what I found after having looked at hundreds of investment portfolios is this. Once you've selected the investment fund with the lowest cost, usually you're already pretty well diversified because only broad market index funds can afford to be that cheap. So in a way, when you start with the cost, the other investment metrics usually follow suit without you needing to do much about it. But the bottom line is this. If you want to ruthlessly go for the metric that will have the biggest impact on your investment portfolio, go for the core. Go for the cost. Remember what our Uncle Warren Buffett once said about fees. Performance comes, performance goes. Fees never falter. Thank you guys for watching the theme of best managing our investments. If you want to learn some of the biggest money and investment mistakes that I often see with my community members that can cost up to $100,000, please check out my video here. Until next time, all the best.